Alrighty, folks, so this is the fifth video on the Maybe series and the 13th on accounting. And in this video, we're going to be talking about walking through different events related to debt on the three financial statements. So the three main ones that I'm going to cover is one is if you borrow, right? So if you like kind of take a loan. The second is if you pay back a loan. And the third is if you incur interest expense, right? And maybe I'll actually switch these two. I'll do them in that order, right? So let's kind of get into the intuition on when you borrow or take a loan. What does that look like? Well, if we think about it on a more natural level, right? Well, if you take a loan, let's say that you take out a student loan, what happens, right? So you get cash and you get a liability, right? That's kind of the intuition there. And when you're paying back a loan, what happens? Well, you lose cash and your liability, or essentially the loan, decreases. Right? So they're correlated in the sense that they're directly correlated. So if you take out a liability, you're going to have more cash on hand. If you pay back a liability, you're going to have less cash on hand. And that's just something to kind of think about as we walk through these three statements, right? Now, the second thing that I want to point out is when you borrow or you pay back a loan, is that something that's related to our profit and losses, right, or P&L, otherwise known as our income statement? No, right? It doesn't make sense that you would consider a student loan that you took out as part of your income for the year, right? That doesn't make sense. Nor would it make sense for you to say that, oh, if you just paid back the principal on a loan, that should be counted as like an expense on your income statement, right? So that's something to kind of keep in mind, that when we're borrowing or we're paying back a loan, that is not on our income statement, right? So let's hop into the first example. So let's say that you take out a loan of $100, right? Or a company issues debt. How's that going to look on the three statements? We have our income statement, we have our balance sheet, and we have our cash flow statement, right? Now, as we know, whenever we take out a loan on the income statement, we don't have to recognize anything, right? That's not going to be counted as income on our income statement, right? So we can ignore everything to do with the income statement. Now we move on to the cash flow statement, right? On the cash flow statement, if you take out a loan, what happens? You get cash, right? Whenever you take out a loan. That's more cash in your pocket. So we're going to adjust that as a positive 100 under cash flow from financing for the loan amount, right? So overall, our change in cash is going to be a positive 100. Now we know on our balance sheet, we're going to have that additional 100 under assets. And we took out a loan, right? So it makes sense that our liabilities would also increase. So under our liabilities, we're going to have the full loan amount, right? And if we want to test this with our like golden formula, it's assets equals liabilities plus our shareholders' equity. Our cash went up, right? That's an increase in an asset, and our liabilities also went up. So this formula balances. So that means that our balance sheet balances, and we're good to go, right? However, this is when we just take out the loan, right? What happens with the interest expense associated with the loan, right? So this is kind of one question. Another question could be, walk me through the three statements if you have some form of like an interest expense, right? So let's do that. And then I'll kind of combine the two, right? So let's say that you have an interest expense of $10, right? How are we going to walk through the three statements here? Well, something that's nice about interest expense is that it kind of tells you that it's an expense, right? So our expenses do show up on our income statement. So let me finish writing this out. So if we remember, we start off with the revenue, we subtract our cost of goods sold, that gives us our gross profit. We subtract out our operating expenses, that gives us our EBIT. At this point in time, now we subtract out our interest expense, right? So there's been no changes so far. All of these are flat. But now our interest expense, as per the question, has increased by $10, right? So this has increased by $10, meaning that our earnings before taxes have decreased by $10, right? Because it's an expense. Then we're going to look at the tax rate. Let's say that the tax rate is 20% because it's earnings before taxes now. So we need to figure out what our taxes are going to be. And we're going to see that we have $2 of tax savings because we have $10 less in terms of our earnings before taxes, our pre-tax income. So that means that our net income is going to be adjusted down by $8. Now we can go over to our cash flow statement. Now on our cash flow statement, we know that our net income starts down by 8, right? And now it depends as to whether or not we essentially paid off that interest expense with cash, right? So if we just flow through this, right, it's just going to show us that we have $8 less of cash. So we have our net income. There's no adjustments to be made here. So our change in our cash is going to be adjusted down by 8, right? Because essentially we incurred this interest expense, we paid it out with cash, right? We're not assuming anything different. So we're going to have $8 less in terms of our cash balance. So now when we move over to our balance sheet under our assets, we're going to have $8 less of cash. Did our liabilities change? Well, this is where we have to be careful, right? Because yes, we incurred $10 worth of an interest expense, but in reality, we paid that off with cash. So because of that, our liability stayed flat. And our shareholders' equity goes down by 8, right? This is where it flows through. And we can check this by looking at our formula. Our assets equals our liabilities plus our shareholders' equity. And we saw that our assets went down and our shareholders' equity went down by an equivalent amount, meaning that this balance sheet balances. So we're in good shape. Now let's look at a combined example. So let's say that you take a loan of $100 and it incurs $10 worth of interest, right? So it's a 10% interest rate on this loan. Well, how are we going to walk through that? Well, on our income statement, let me write these out first. On our income statement, we are going to recognize the $10 of interest expense, right? So instead of writing everything out here, I'm just going to write our interest expense is $10. that means that our pre-tax income, otherwise known as our EBIT, is going to be decreased by $10, right? And assuming a 20% tax rate, that means that our net income is going to be adjusted down by $8, right? And the reason why I'm not writing everything out here is that at a certain point, if you get this question, they expect you to answer it essentially at that point in time. This isn't really a question that I would say that you have the liberty of asking for additional time because it's relatively simple, right? If it's a merger math question or something like that, then you can definitely ask for a moment or two. But for this question, I would say that instead of writing every line item in the income statement, you should just understand where interest expense sits, how that adjusts your pre-tax income, and how that's going to adjust your net income, right? Now we start on our cash flow statement. So we have our net income. That's going to be down by 8. But we also have to recognize that we took out a loan of $100 here, right? So under cash flow from financing, you're going to do an additional $100 that's available to you from the loan, meaning that overall, your cash has increased by $92 because our net income is down by 8. Our cash flow from financing, we got $100 for taking out that loan. So if we net the two, we get $92, right? Now let's move on to our balance sheet. So we know that our cash is up by 92. We know that our liabilities or our loan, right, A, L, and SE here. We know that our loan is 100, right? Because we didn't actually pay off any of the principal of the loan. All we did was take this loan out and pay the interest on it. So our liabilities are up by 100, and we know that our shareholders' equity flows through from here. So that is down by 8. So let's sum that up here, and we'll be able to see our assets equals our liabilities plus our shareholders' equity. And we had a plus 92 here, we had a plus 100 here, and we had a minus 8 here, meaning that our balance sheet balances in this scenario. So hopefully we can understand how taking out a loan and the interest expense associated with that loan kind of flow through the three statements. Now, in reality, the first two examples that I gave are possible questions that you could get, but the most likely question that you would get of this nature would be something like this, right? So what does it look like to essentially take out a loan that incurs some amount interest? They might give you a percentage and ask you to calculate out that percentage into dollars and then apply that. But this is the way that I would kind of walk through it, right? So you incur the interest expense on your income statement. That's going to adjust down our net income. That flows through to our cash flow statement, but we're going to add back the full loan amount because we took that loan out. That's going to lead to our change in cash. That flows through to our balance sheet. We're going to, on the liability side, include the amount of the loan, and we're going to adjust down our shareholders' equity, right, by the net income. Now let's look at if we repay a loan worth $100. So we have our income statement, our balance sheet, and our cash flow statement, right? Well, again, if we remember from the first page here, when we pay back a loan, does that show up on our income statement? Would you say that that is part of the profit and losses of a specific company? No, right? So when we move to this example, when we repay a loan worth $100, we're not going to see any adjustments on our income statement. Now let's move on to our cash flow statement. Well, what had to happen in order for us to pay back that loan? We had to pay $100 out of our pocket, right? So under cash flow from financing, we're going to see an adjustment of a negative $100, meaning that our cash overall went down by 100. So that flows through to our balance sheet. So we have $100 less in cash. And we know that when we pay back a loan, the liability amount of that loan is going to decrease. That means that you owe less for that loan, right? So if we check our golden formula, we have our assets equals our liabilities plus our shareholders' equity. Our assets decreased, our liabilities decreased by the same amount. So this checks out in our balance sheet balances, right? So essentially that's kind of the majority of the questions that you will get when it comes to debt on the three financial statements. There is one more nuanced question that I will cover in probably the next series around essentially using $80 worth of cash to retire $100 worth of a loan, right? So it sounds kind of complex, and on the three statements, it is far more complex than this. But that's not a question that I would really lose any sleep over. It's relatively rare that you would get something like that, and I will make a video on that as well. But for the most part, this is all that you really have to know in terms of debt on the three statements. So I hope that's been helpful.